When it comes to investing, there are two broad strategies or philosophies: active investing and passive investing. Which one is right for you? Hi, I'm Laura Adams, an award-winning personal finance author and Money Girl podcast host with over 43 million downloads. For over a decade, I've helped millions of readers and listeners understand how to manage money and build wealth. Our goal is to offer tips and advice you can put into action for more financial security and success. This video will give you major pros and cons for active and passive investing and tips to boost your returns. If you're an active investor, that means you buy and sell investments like stocks, exchange-traded funds, or commodities on an ongoing basis. You keep an eye on the financial markets and you make decisions like buying a stock when its price dips and selling when its price rises to make a profit. In other words, active investors try to time the market to take advantage of short-term price movements. That takes expertise to analyze company financials, read stock performance charts, use trading software, and understand how changes in the economy affect investments. As you can imagine, if you're really good, the upside of active investing could be huge. But if you're not skilled, you could lose a lot of money. Not only can trying to time the market be risky, but the trading fees you must pay for every transaction can add up. Now, let's talk about passive investing, the other main strategy, which is just what it sounds like. If you're a passive investor, you have a long-term view of investing, which is also known as a buy and hold strategy. That means you regularly buy low-cost investments like index and exchange-traded funds that are likely to grow over the long term. Passive investors aren't concerned with short-term price changes or trying to time the market. So who's likely to make higher returns over time, an active or passive investor? Various research shows that over decades, a typical passive investor comes out ahead. That's because average active investors are prone to buying investments at the wrong time. For instance, they might buy a stock when its price rises, but panic and sell it when the price drops. Buying high and selling low is the opposite of how you make a profit. Active investors tend to chase trends and even overreact to news, which can lead to irrational, bad investment decisions. That doesn't mean you should never make a trade, especially if you enjoy analyzing data and can afford a potential loss. But if you're like most people who don't want to spend a lot of time researching investments, sticking to a passive strategy will give you higher returns for much less effort. You might regularly contribute a flat amount or a percentage of your gross monthly income to a retirement account or a brokerage. By selecting diversified index, mutual, or exchange-traded funds, you'll get broad market exposure, which has historically paid nice returns to long-term investors. There aren't many situations where being lazy can pay off, but isn't it nice to know that investing is one of them? To learn more about investing, visit finder.com. Thanks for watching. If you like this video, please subscribe and you'll get notified when there are more helpful product reviews, money tips, and advice.